this report, the 14th of May 2025. Right. Today, I'll talk about the US dollar and the S&P 500 outlook amidst yield spikes and trade policy shifts. Now, Liberation Day tariffs far exceeded expectations and rivaled the protectionism of the 1930s, leading investors to fear a severe global slowdown and surging prices. Now, the immediate market fallout was dramatic. As we all know, stock plunged in a near panic. The S&P 500 tumbled about 10% in just 2 days following the tariffs announcements, erasing trillions in the market capital. This was the worst sell-off since the 2020 COVID crash, with the S&P's one-day drop of 4.8% on April 2nd, marking the largest single-day loss since 2022. Now, here is a look at the latest market response to the tariff negotiations during the 90-day pause, which highlights the complex interplay between rising bond yields, elevated debt servicing costs, and shifting investors' sentiments, right? So let's kick off first with the 90-day tariff truce, right? Now, as you can see from here, during the weekend, US-China negotiations in Geneva yielded a surprise breakthrough, a temporary truce rolling back most of the Liberation Day tariffs. The United States agreed to slash its April tariff increases on Chinese goods from 145% down to 30%. And China likewise reduced its retaliatory tariffs on US imports from 125% to just 10%. Okay. Now, this 90-day pause effectively immediately far exceeded investors' expectations. Many had only anticipated preliminary talks with few concrete results. Now, the bulk of the punitive April tariffs were effectively unwound, at least temporarily, with both sides framing the pause as a chance to work toward a more comprehensive deal and a willingness to keep negotiating over the next 3 months. Now, it's also important to note that even after this rollback, tariff levels remain historically high. 30% is still the steepest US import tax since the 1930s, according to the Fed, okay? Now, however, relative to the worst case scenario that had been on the table, where Trump said 80% sounds good, right, of tariffs on some items were removed as recently as the prior week. That's from Donald Trump. Now, the truce was an ambiguous positive for market sentiment. So what came out really, it was a positive thing. Now, the tariff de-escalation sparked an immediate relief rally across asset classes. US equities roared higher on May 12 when the truce was unveiled, with the S&P 500 soaring 3.3% in a single session. The S&P 500 had fully recovered its Liberation Day losses, climbing above its April 2 levels. Now, this is a good thing, which is also good for the stocks we have bought recently. So next, there are few other things that we need to look at, because it is not, everything just blue skies from over here. We have to be careful. There are certain things that we need to look at, mainly the bonds, okay, because they do bring different signals at different times, right? So first, let's look at the 10-year bonds on the rise. Is this a sign of stability, or is it a warning? Okay. Now, key feature of recent market dynamics is the sharp rise in the US 10-year Treasury yields, now hovering around 4.45%, up from a low of 3.86% in early April. Now, this upward move, while not seen as a sign of normalizing conditions, originally had far more troubling consequences. Okay, so it's now seen as normalizing, but in the past, it was different, because during that time, when the yield spiked, the market panicked. But right now, the yield spiking, it's a sign of normalizing conditions. Okay, so let's dwell deeper and see. So in early April, when the Libertarian Day tariffs were announced, market went into turmoil. The S&P 500 collapsed 15.6%, the US dollars lost 6%, and most notably, the 10-year yield surged from 3.86% to 4.9% within days. Now, instead of the usual flight to safety in bonds, investors feared the inflationary effects of tariffs and questioned the US government's fiscal trajectory, triggering a bond sell-off and yield spike. Now, this sudden rise in yield alarmed the White House. High yields means costlier government debt servicing, a dangerous feedback loop given already elevated borrowing needs. Now, the spike forced Trump's administration to immediately announce a 90-day pause on the reciprocal tariffs, excluding China, on April the 9th, just days after the market chaos began. But right now, it's totally different because right now, we have yields still rising, but stocks rebound. So fast forward to May, the 10-year yield is still elevated, but the stock market is rallying, not retreating. The S&P 500 has fully recovered its tariff-induced drop, and the US dollar is strengthening again. So why the contrast, right? Yields are rising for good reasons right now. Rather than reflecting panic or policy mistakes, today's rising yields are tied to easing recession fears and trade truce optimism. The May US-China agreement to roll back most tariffs has reassured investors that worst-case trades risks have been diffused, at least temporarily. There are also improved sentiments and rotation into risk, okay? Because improved sentiments equals to rotation into risk. With the economic outlook stabilizing, investors are rotating from treasuries, meaning they are selling their treasuries and moving back into stocks. Short-term yields have also climbed, steepening the yield curve, a sign that market sees less chance of recession in the near term, right? So when they sell the treasuries, yield will go up, okay? So that's what it is. So next is the Fed expectations recalibrated. In April, markets were pricing in aggressive Fed rate cuts in response to shock, but with trade tensions easing, that urgency has faded. Traders now expect only 1 to 2 rate cuts this year and possibly none. Also, because there are some that even say none, but we think there will have at least 2. Now, rising yields reflect this shift in expectations, a sign of resilience, not fragility. So anyway, is this all blue skies from over here? I think we should still be cautious. And why we should still be cautious? While markets appear to be shrugging off yield spikes for now, this balance is delicate. Because, like it or not, when interest rate is high, debt servicing pressures remain real. Every 1% increase in yields adds tens of billions to the annual interest burden of US debt. With Treasury issuance expected to exceed 500 billion this quarter, higher yields could strain the federal budget, especially if growth slows or deficit widens again. Now you know why Donald Trump is calling for Powell to cut rates, keep on cutting rates. Everything is fine. There's no inflation and so on. He is pressuring because of this. When yield increases, so does the ability of Donald Trump to spend. And if he cannot spend, he cannot fulfill a big bulk of his promises. He cannot even cut the tax, because where is going to get the money to fund all his spending for his plan to make America great again, right? So equity risk premium is also shrinking. If 10-year yields rise much beyond 4.5%, stocks could come under pressure. Valuations, especially in growth sectors, depend lower discount rates. A sharp climb towards 5% would make bonds relatively more attractive and hurt equities, especially if inflation expectations rise too. Then also we have the Fed policy still uncertain. The Fed has maintained a cautious and reactive stance, but it could shift quickly if inflation re-accelerates or if bond market stress re-emerges. The unofficial cap on yield is also as strong as economic data allows. Okay. And then finally, also the tariff truth is temporary. The current optimism is built on a 90-day pause. If talks falter and tariffs return to April levels, market will not react kindly. Another surge in yields with renewed uncertainty could be far more destabilizing than the first one that we've seen on April the 2nd. Okay, so that is based on the bond. What about the US dollar? Let's look into that. The US dollar rebounded on trade optimism overall. Now, the US dollar trajectory in the past month underscores how sensitive forex markets are to trade news and interest rate expectations. In late April, the dollar index had slumped to 97.656 on April 21 amidst the fallout from Libertarian Day and speculations that Fed would slash rates to support growth. By May 13th, okay, the US DX had rebounded above the 101, reflecting a significant shift in sentiments. This 4% dollar bounce aligns with the de-escalation of the trade war and repricing of Fed policy. There are several factors behind the dollar rebound. First of all, trade war de-escalation. As the US and China hit pause on tariffs, fears of a US-led recession add, making dollar assets more attractive again. Early in April, the dollar had strangely weakened during the sell-off, unlike typical risk-off episodes where US dollar strengthened because the trade war was viewed as a US-specific growth negative, and that's why the sell-off happened. Now, that is the market was more worried about the US economic damage and aggressive Fed easing than about global instability, so the greenback fell on tariff news. Now, once those extreme tariffs were rolled back in May, this US-centric risk premium faded. The dollar rebound reflects optimism over trade de-escalation, confirming that much of its April weakness was tied to trade drags concern. Indeed, safe haven currencies that had jumped versus US dollars like the yen and Swiss franc gave back gains when risk sentiment improved. In effect, removal of the worst-case trade scenarios allowed the dollar to resume trading on fundamental rather than fear. Okay, so this is something that what's happening right now. And when it's trading back based on fundamentals, things will normalization happens. Okay. And also next thing, there is a possible scenario for the US dollar if global growth improves, right? A possible scenario here. Now, cooling of trade war trends to improve the global growth outlook, which can have mixed effects on the dollar. But this is not now, it's on a later time, okay? On one hand, better global growth often weakens the dollar as investors feel confident to move money into riskier emerging markets or undervalued currencies. On the other hand, in this scenario, the US economy is also doing better than feared, so there is no exodus from US assets, especially as US equities are hitting highs again. In the immediate aftermath of the truce, the risk-on wave actually lifted the dollar, which might seem counterintuitive. This is because the dollar prior drop was tied to US trade policy. When that trade policy recedes, the dollar bounced even as overall risk appetite improved. Over a slightly longer horizon, if trade peace holds, we could see a more typical pattern, a stable or gentle softer dollar as global growth picks up and investors diversify into non-dollar assets. But over the next few months, with the US still offering high interest rates and solid growth, the dollar is likely to remain well supported. Okay, that's for now. Now, optimism on trade has removed a big downside risk for the greenback. Unless we see a sudden revival of tariff threats or a major shift in Fed stance, the path of least resistance for dollar index could be sideways to modest higher. Okay, and then finally, let's look at the S&P 500. It has recovered and inspect investors' expectations of it. Now, S&P 500 round trip journey from sharp liberation day losses, not libertarian, liberation day. I was reading libertarian, sorry. Losses to a full recovery by May speaks volumes about investors' expectations. Now, essentially, equity investors have decided to look past the trade war scare, focusing instead on the resilience of earnings and the likelihood that policy extremes will be avoided. Several points highlights what the S&P 500 rebound implies. Now, first of all, confidence in earnings and economy. Past reports have covered about the earnings already. The earnings so far has been good, right? So despite the tariff turmoil, corporate America has so far delivered solid results. First quarter earnings largely beat expectations by 8% on average, and many companies navigated the initial tariffs better than feared. As of early May, with most quarter one reports in, earnings growth was modest but positive, and revenue growth showed that demand remained healthy. The labor market also stayed strong. The US added 177,000 jobs in April, even as trade anxieties peak. In short, the S&P's resurgence reflects a view that growth will continue, albeit at a slower pace, and that companies will find ways to adapt through pricing, supply chain adjustments, etc., even if some tariffs persist. Now, I've also covered this particular area in previous report where the expectations, the ending expectations would not be as high. It's probably in the single digits for the remaining quarters, but nevertheless, it's still showing growth. Okay, so next is the assumption of temporary trade impact. The market's behavior suggests that investors expect the worst of the trade conflicts to be behind us. The fact that S&P 500 is back above its April 2nd levels indicate traders believe the Libertarian Day shock was one-off event and not a lasting trend. Now, this could imply an expectation that either a US-China deal will be reached within the 90-day window, or at minimum that the tariff pause will be extended and no return to 145% tariffs will occur. Essentially, equities are pricing a successful de-escalation scenario. Now, investors may also be betting that President Trump, heading to an election year soon, will avoid moves that tank the stock market. Now, this election year is referring to the lower house. Okay. Now, the rapid rebound shows a degree of complacency about trade risks after years of on again, off again tariff threats. Market and participants have grown used to initial dips being buying opportunities once policy softens. They have seen this in the past as well. This time appears no different as indexes rip higher on any hint of compromise. That said, this optimism could be tested if negotiations hit the snag. Well, Wall Street is essentially assuming a benign outcome. Any deviation, even just a prolonging of uncertainty past 90 days, could inject volatility again. Overall, the S&P 500 furious rally since early April signals that investors' expectations are skewed towards a constructive resolution of the trade dispute and sustained economic growth. The key will be whether reality in the next few months matches these hopeful expectations, or whether there are negative surprises in trade talks or data that challenge the market's sunny outlook. Okay, so as a conclusion, this table here, if we have tariff de-escalation, the dollar likely remains firm or strengthens slightly. Continued trade optimism and relatively higher US interest rate supports the US dollars. If global growth pick up broadly, the dollar might stabilize or inch down later, but in the near term, risk appetite is coexisting with a strong US dollars. Okay. For S&P 500, it's likely to resume its uptrend if inflation plateau or drop. For the bonds, likely to remain at between 4.3% to 4.6% as bond markets expects no urgent Fed rate cuts. Higher yields reflect stronger economy and trade optimism. Now, if we have a tariff re-escalation, dollar might strengthen or a repeat of previous move. Either this could happen, okay? With the latter spooking the Trump administration very, very much. For S&P 500 would almost certainly tank in this scenario. For the bonds, bond yields might drop or a repeat of previous move as well, okay? So as you can see, re-escalation will bring much more uncertainty for the US dollars and the bonds as well. But for the S&P 500, like I said, it would almost certainly tank, right? So hopefully this sharing today has enlightened you much. So that's the report for today.